Good morning and welcome once again to Digital Look TV. Joining us today, once again, fortunately, is Bill Hubard. He's Chief Economist at Markets.com. Bill, thank you very much for being with us.
Thank you very much for inviting me. And what a lovely day we have here on the veranda.
It's a beautiful British summer morning.
Exactly.
Okay, let's talk about the largest economy in the world, the most important economy in the world, the United States economy. We had Q1 GDP data, second revision out yesterday, quite a bit of a crater. It was revised down second time around to minus 2.9%. Quite a bit worse than what people were expecting. Does that show that the U.S. economy is not quite as strong as one might think, or not?
Well, I'm going to have to go back to years ago when I was a TV presenter at Bloomberg, and we got GDP numbers out one time. And as I got off set, my producer came to me and basically said, well, your reaction wasn't what we expected. I said, well, you know, I'm a trader, okay? I got 10 seconds to look at something. Is that a good number or a bad number? Okay. I said, your background is being an economist. Therefore, you have at least 3 chances in the space of 3 months to evaluate what's going on. And I think as we saw this, the bond market took it as positive. The 10-year went down to 2.5%. The equity market said, well, moving right along, that's old data. And we had, again, record sets on Wall Street on decent volume. But the key thing, I think, to look at that data. Remember, the quarter started with a continuation of the incredibly cold winter that we had in both February and March. So the consumer basically was staying home, freezing to death. And also, I think one thing to look through, I guess the economists were working under the assumption that the second quarter would start off strong because of the introduction of, quote, Obamacare, feeling that the consumers would be spending hundreds of millions of dollars increasing their coverage, which was becoming law. Well, as we saw, the first 6-8 weeks of that was sort of, you know, the system didn't work and you couldn't log online. So I think you saw a dramatic reduction in what they were assuming to be consumer spending. But I think one of the things, if you look through it, capital expenditures were okay. Housing was okay. So the simple fact is the market, I haven't seen today what, you know, the gurus have reevaluated. But I mean, yesterday when we were, the Bloomberg consensus, I think, was minus 1.8 as the final number. You know, they were saying, well, you know, Q2 could be 3%. Well, let's just say if they're still just expecting 3% to 3.2% in Q2, well, all of a sudden this will be even a more dramatic improvement since the number finally came in at minus 2.9. So the simple fact is you saw the dollar come under some pressure, but you saw very strong buying in the equity markets. And again, the bond market saying, well, you know, it means that the Fed Reserve is truthful, that we probably won't get any kind of rate hike till probably late 2015, early 2016.
Okay. So then that's a very important point. So, or rather 2 points. On the one hand, the U.S. economy, the U.S. economic recovery is for real.
Yes, it is.
That's critical. But following on from that, or despite that, given the nature of the U.S. economy, exactly how it works, the dynamics that work there, the Fed is right to be patient with the first rate hike.
So.
Okay. Now let's compare that with the UK.
Okay. Well, let's go back to now next week. All right, next Thursday, because of the holiday next Friday, we will get non-farm payrolls. My call now is plus 215,000, which would be slightly over the one-year average, which is 196. We could see a drop of 6.2. Now, one of the things, and we talked about this earlier, was there are still probably 400,000 plus potential, you know, people looking who've just given up. Okay, now. Even if the economy starts to improve slightly, we were talking about, you know, what happens, you know, with the potential of U.S. exporting oil. Well, if this Keystone LX comes in, this could be several 100,000 jobs near term. So the potential is there. And again, the equity markets are looking at the potential of disenchanted workers being able to come back looking for, you know, for jobs.
Okay, so you believe that's something you take into account in the next 12 months? Perhaps?
Yes. Yeah, I do.
That is critical. That's extremely important. Thank you. All right, we'll follow on from the XL pipeline, this entire oil theme.
Yeah.
Iraq.
Yes.
Medium-term implications for the price of oil, for Brent, but in particular, you made a, how would I say this, an analogy before the interview for OPEC, XL pipeline, U.S. exports of oil.
Well, I think one of the things that we have seen, okay, ever since, quote, fracking came into the general conversation, you know, we've had no problem with OPEC even thinking about reducing it. I mean, even like Saudi Arabia, I think in the last day or two has said, don't worry, it's there. Also, the fact is, if political negotiations with Iran continue, I mean, Iran has the potential to be probably the second or third largest producer of oil in that area, okay? So that could help it, and I think, the decision by the Norwegian central bank, last week, where they became far more dovish than being hawkish in the previous meeting, and their basic assumption then was Brent crude could go to 120. I mean, I think the last I looked, it's still hovering around 115.
Indeed.
And it's not
114 this morning.
Okay, so if nothing else, we've seen at least a slight reduction, whether it's profit taking or this, that, or the other. And again, getting ready for the weekend, and next week, we have a long weekend, with both U.S. and Canada being closed next Friday. So, it's a situation where, I guess here in the UK, we're not following the World Cup anymore, but we're now into Wimbledon.
Okay, so the medium-term prospects for oil for Brent are more or less under control?
Yes, I think so.
And geopolitically, I guess perhaps the void that Iraq might leave behind will be filled in, and also that threat to OPEC's production, to its, I guess you could say, omnipotence, will check it.
Yes, and I think OPEC has been smart enough to realize, we'd rather get 108, 110, 112 dollars a barrel rather than 80. And I mean, there are people out there that are talking that, that Keystone comes on, fracking comes on. I mean, they're one or two, noted institutions that feel that oil could go to $80 a barrel.
Right. So a good threat is sometimes useful.
Yes.
All right. Going back to the U.S. Federal Reserve, Janet Yellen, Fed chair. She's doing the correct thing by being patient.
Yes.
Mr. Carney, he seems to have, he and the MPC before the Treasury Select Committee, they seem to have backed off slightly from his words at the during the Mansion House speech. Should he too be patient like the Fed or not?
Yes and no. Let's go back to, he hadn't even been there a year yet. I think it was July of last year. And I hope pro-Carney fans will not think I'm anti-Carney, but let's be perfectly realistic, okay? Being governor of the Bank of Canada is slightly different than being the Bank of England, okay? We're talking about, an economy unto itself, because remember, so much of the Bank of Canada's direction comes from its southern neighbor, okay? And they just sort of act or react. So I think he's growing into the job. I think one of the things that he has to learn is to be a little bit more political. And I guess it goes back to probably 25 years ago when Alan Greenspan was chairman of the Fed, and every 6 months he has to go before what they call the Humphrey Hawkins.
Yes.
And he made a comment before the Senate, and he said, well, Senator, I'm not trying to be derogatory, but if you understood what I just said, you must not have been listening. And I think maybe the situation where possibly now, he's listening to members of the BOE MPC. And I know there was a comment yesterday, I guess, from one of the parliamentarians saying, wait a minute, he's sort of like it sounded like, what did you call him, a scorned boyfriend or something like that, that he, well, I'm not going to talk to you again. But I think one of the things he's having to look, but I think the key thing is what he'll have to look at is the market, the slack, and he is no different, whether it be the Federal Reserve or the Bank of England. The economy has improved in reference to employment/unemployment far quicker here, much quicker, than anybody expected.
Two last things, if you allow me, about the Bank of England, the MPC. First of all, some economists say that there's a 40% chance of CPI in the UK and finishing the year below 1%. Do you believe that?
No, I don't.
Okay.
I don't see any problem with inflation. But now, those may be the people that, as I just mentioned, let's say Iraq is settled today. Iran comes on at full force, okay?
Okay.
OPEC then we could have, and as I say, maybe it goes back even early part of this year. I mean, there were one or two major institutions, well-known institutions. We're talking the real possibility with deflation being the problem now, where we can see oil well below, finishing the year well below, like in the 85 to 90 bucks a barrel. Okay? Well, that would totally be deflationary rather than inflation. Now, also one of the things we mentioned earlier is that, let's just say, and the market now is still implying, I think, 60-ish% probability of a November hike, or no, 90%, 60% probability. Now that may have changed in the last day or two because of the data. But what is wrong with the Bank of England saying, well, we are going to start raising rates in November, but what's wrong with 10 basis points? Does it have, just because, it's been 25 basis points since, King Canute was around in 4000 BC. What's wrong with 10 basis points? What's wrong with 15 basis points? Or as Greenspan told us years ago, the market tells us what the rates are, we just react accordingly. Okay? And so what difference does it make whether it's 10 or 15 basis points
Certainly it
rather
does
than
not.
25? No.
Okay, going back to your previous point,
Yeah.
if oil, Brent, fell towards $80 a barrel, $90 a barrel, dollar would go higher?
Yes.
Okay, interesting. Also, the BBA,
Yeah.
British Bankers Association, 2 days ago, they put out a statement more or less telling Carney that don't rush into anything. Are they right?
Let's just say politicians shouldn't get involved in business and vice versa, okay?
Okay.
And so everybody has the right to make any kind of statement, okay? And
fair enough.
what is it worth? That and £2 gets you on the London Underground. So, it's a question of, my feeling, I think we've talked about this before, depending on who you believe, there's anywhere from like 8.2 to 11.4 million mortgage holders here in the UK. Now, we know, even with the price of oil, they're probably going to pay another, in this month's inflation data, you'll probably find maybe 3 to 4p per litre that they paid more for petrol. Well, so if petrol's going up, the credit card's the same. We're getting ready for winter. So all of a sudden, if you're having to pay, I don't know, 50, 100, 150, and you're still getting wage is well below even the current inflation rate. That's just money that's coming out of your pocket. And where are you going to replace it? By not buying a new pair of shoes and not, going out to the best restaurant. So,
Okay, so steady as you go for Mr.
yeah,
Carney.
I think so. But I mean, I do feel, looking at the data now, that we will get a rate hike prior to year end. Okay.
Okay, and very possibly in November.
Yeah, I think so. December's always a bad month, okay? Christmas and stuff like that. You don't want to, I mean, the high streets would be, let's just say they decided to do 25 basis points. The high streets would go ballistic. And that's a word I can use on television. I wouldn't want to use the other word.
No, best not.
They'd go crazy if all of a sudden there was a rate hike before the Christmas holidays.
I have no doubt they would.
Yeah.
Bill Kubart, Chief Economist, Markets.com. Thank you very much for your time.
Thank you.
As always. And that's all from us here today at Digital Look TV. Thank you very much for your time.